This is Wallet Brief, where we cut through the noise and focus on what matters to your money. Stock market today, searches spiked again this week, but Friday's close told a different story than the headlines suggest. The S&P 500 declined 1.4 for the week, yet beneath that surface number, something more important was happening. The market is rotating, not collapsing. As investors head into President's Day weekend, the question isn't whether stocks are going down, it's where money is going instead. The week wrapped up with tech giants continuing to struggle. Rotation from U.S. large caps, especially the Mag 7, into value, foreign stocks, and defensive sectors continues to gain momentum. But here's the twist. The S&P 500 Equal Weight Index actually finished up 1.0 this week. That means the average stock did fine. It's just the biggest names that dragged the headline number down. Utilities especially were strong, and when every stock in a sector closes green in a session, that's rotation you respect. Healthcare, materials, and industrials also showed resilience. Meanwhile, the jobs data sent mixed signals. Stronger employment supported growth optimism, but it also pushed back expectations for Federal Reserve rate cuts. Here's what's actually happening. Investors are moving money out of expensive tech stocks that dominated 2024 and 2025 and into companies with steady earnings, lower valuations, and less AI disruption risk. This isn't panic selling. It's capital looking for earnings visibility and stability while uncertainty lingers in AI and high-multiple software. Small and mid-cap stocks held up better than the Nasdaq, and defensive sectors like utilities surged because they offer predictable dividends and low volatility. The market isn't falling apart, it's repositioning. A bear market probability model assigns a 25% chance of a bear market in the next 4 to 6 months, which suggests caution but not alarm. If your retirement account is heavily weighted toward big tech, think the Magnificent Seven. You probably saw red this week. But if you're diversified across sectors, you may have fared better than the headlines suggest. The equal weight performance shows that stock picking and sector allocation matter more right now than just riding the index. For investors nearing retirement or those seeking stability, this rotation toward defensive stocks and value names could actually be a positive development. It suggests the broader market has underlying strength even as the most expensive names cool off. If you're still working and have time, this could be an opportunity to rebalance toward undervalued areas. Markets are closed Monday for President's Day, which gives everyone a 3-day weekend to digest this rotation theme. When trading resumes Tuesday, watch how defensive sectors perform. If utilities, healthcare, and consumer staples continue leading, that confirms the rotation is real. Also keep an eye on earnings reports from non-tech sectors. If they show solid growth, that validates the move away from megacap concentration. Finally, any news on Federal Reserve rate cut timing will matter, especially with inflation data coming later this month. This isn't a breakdown. It's a transition. That's it for today's Wallet Brief. Subscribe for daily updates on what's moving markets and your money.